Hi everyone, this is Patrick Donahoe from Paradigm Life. Today I'm going to be going through the mechanics of utilizing the infinite banking concept and the corresponding insurance policy to purchase the things that you would have otherwise had to use cash or credit to buy. So let's kind of get into just the conceptual details first. So let's say that you had taken the money that you were otherwise allocating to a 401k, to an IRA, to a Roth IRA, to a 529 plan, and instead of putting money into those qualified vehicles, tax qualified vehicles, you decided to fund your insurance policy. And this funding would be properly set up through the utilization of a paid up additions rider, which would maximize the amount of cash value you have even in the first couple of years. So you establish your cash value at this point. Basically, the insurance company, as a basically an opportunity you have with them, or a right that you have with them as a policy owner, they will lend you up to the entire amount of cash value that you have. So let's say that your cash value is $10,000. The insurance company will then give you a loan against your cash value. Now, these loans are some of the easiest loans to get. There's no qualification. You do not have to repay them at a specific period. It does not show up on your credit report either. Okay, so the loan, let's say that you take out $10,000 and you purchase a vehicle with this money. I'm not the greatest at drawing vehicles, so I'm going to do my best. All right, there's your car. Okay, so you purchase your car for $10,000. The infinite banking concept teaches you to pay back this vehicle at the interest rate, or slightly a higher interest rate, that you would pay to a third-party creditor, bank, or credit union. Okay, so let's say that you choose to pay back at 9%. Now, the reason why we choose 9%, it's an ambiguous number. It represents the value of a loan that does not have a specific repayment period, that you do not have to qualify for, that does not show up on your credit report. It is your banking system as well, and you treat your banking system with value. Now, the insurance company, when they do give you this loan, they are going to charge interest for that loan. Let's say the interest, which is currently on the companies that we use, around 5%. So, on a monthly basis, you are basically going to be making a loan payment that is ultimately going to go to the insurance company and pay their interest. Any overage is going to increase the value of your cash value. So let's say that we do this on a 5-year term. So for 5 years, you will set up a payment of X amount of money every single month. A portion will go to the insurance company to pay off the loan at 5%. The remaining amount will go to your cash value to increase that cash value. So what I like to do is use a software program called Truth Concepts. You can learn more about Truth Concepts by going to their website, which is www.truthconcepts.com. There we go. So what I've done, and for those of you who have not watched the video, The Truth Behind Buy Term and Invest the Difference, please do so now before we proceed. All right, so let's go to this borrowing calculator. What I've done here is I've imported an illustration which represents a 35-year-old with a maximum accumulation of paid-up additions into a life insurance policy. And what I'm going to do is I'm going to say that there is a $10,000 a year contribution for the first 5 years and a $3,000 contribution for the succeeding or subsequent years. All right. And this right here basically reflects the total amount of cash value that is available. So what I'd like to do is show the insurance company's loan rate at roughly 5%. And what I'm going to do is I'm going to start out taking a loan from the policy for a car. And we're going to purchase a $10,000 car. Now, in the first year, you're not going to have the full amount of your cash value. Again, please go to the truth behind buy term invest the difference to have a proper explanation for this. In the second year, you will have enough for your car purchase. So let's say that we take this $10,000 loan in the second year. Right now, let's do one loan. We will repay this loan in 5 years. Now, to repay this loan at principal is going to be $2,000 per year. Okay. Now remember, we are not going to pay this at principal, which would be about $167 per month. We are going to pay this back with interest. Okay. So let's say that we pay back at that 9% I just identified. Okay. By paying back at 9%, this is what occurs. Now remember, as you're paying back at 9%, there is going to be an interest expense at 5%. Okay, so as you make payments back to yourself over that 5-year period of time, let's look at the impact that it has on your overall cash value. So previous, if you took no loans, at that 6-year mark, you'd have $52,754. Now, going back to the truth behind buy term and invest the difference, you would actually have to have over a 10% rate of return in a mutual fund every single year, compounded to match what the overall accumulation is inside of a properly set up whole life insurance policy. So taking a loan out of $10,000 and paying yourself back at just a little bit additional money would come out to be $25.71 per year. So that's a little over $200 per month. Okay, the increase in your account value would be roughly $1,600 or $1,400, which is for one vehicle. Now, where did that money come from? That money came from you basically paying yourself back at a higher interest rate than was charged by the insurance company. So let's say that you continue to do this for all of your cars. Now remember, these car purchases would have had to have been made, or would have had to have been made by going to a credit union or purchasing the car cash. All right, so let's say that we'll put some inflation on there. And let's say that you purchase 5 cars at that value, and you do so every 5 years. So what impact are all of these loans going to have with your policy? So at the end of this 26 years, if you've purchased your vehicle and you've paid yourself back at a 9% interest rate over 5 years, okay, you will now have $292,000 as opposed to $274. So that's about an $18,000, okay, $18,000 impact on your overall cash value. Now that's just for one car. Let's say you started to purchase both of your cars. And let's say the second car was a $15,000 car. So let's label this car number 2. Okay, and let's say you purchased that $15,000 car in year 3. Now again, this purchase is basically something that you would have otherwise had to have made by using cash or going and getting a car loan from a credit union or a bank. Let's again do one loan. Actually, we'll just go ahead and do the 5 loans for because of time's sake. Years to repay, 5 years, 9% interest rate. Okay, and we'll put some inflation on there. So your loan payment is going to be just over $300 a month, which will come out to be $38.56 per year. So let's see what impact a $15,000 car will have on your overall financial situation. So at year 27, okay, instead of having the $313 with the one car, you would have $341. So basically, you've increased your total account by $28,000 and change. Okay, pretty significant impact. So let's say that you start to do your vacations this way. Instead of using a credit card, instead of paying cash for your vacations, every single year you use your policy to do so. Now let's say you start with a $3,500 vacation in year 1. Then you take a vacation every year. We'll put 29 loans on there. Years to repay, pay back in 1 year. Let's say you charge yourself 10% interest. Again, this is money that you would have had to have saved to pay cash for a vacation, or using a credit card and paying that credit card back over the year before the next vacation. That would bring you to $432,000. Okay, so that would increase your total account value, okay, by about $18,000. All right, now let's say that, as I mentioned before, instead of putting money into a 529 plan for education, you decided to take a loan out for education expenses, okay, and lend that to your child for tuition, boarding, etc. Now, one thing that we teach families is to implement what's called the family banking concept, which is when children are going to go to school or buy a car or use money, they do it from the family bank standpoint, which means that if they borrow from the family bank, there is going to be a required payback over time. So if a person or a child uses the loan provision or the family banking concept to pay for their tuition, once they graduate, they would be required to pay back the family banking system at an interest rate. So let's say that school is going to cost 14 years from now, let's say $95,000. Your first loan, 14, one loan, and let's say that that's paid back over a 10-year period of time. And let's say there's an 8% interest charge on that. All right, if we do 3% inflation, there won't be enough money there. So let's just assume that education costs $95,000 for a 4-year education, room, board, and so forth. I know education expenses are increasing, but nonetheless, this policy is able to sustain this. Now, what's also important to note at this point is that this is a $10,000 a year contribution for 5 years. The reason why we do that is because there is an IRS regulation that limits the amount of money you can put into an insurance policy, and they limit how quickly you can do so. So basically, one of the things that we do at Paradigm Life is we will set up multiple policies. And so this is one policy. Typically at year 6, we'll either start up another $10,000 policy or a $7,000 a year policy. Okay, so this just is illustrating one policy. So it basically is able to sustain that $95,000 loan. Let's see what impact that has. So $468,000 is what you would end up with. Okay, you would have only had $432,000. So that's a $36,000 increase in cash value because of taking out this $95,000, paying it back with interest over a 10-year period of time. All right, let's do one more. So I have two girls. They are, one's almost 5, but right now 4 and 6 years old. So I'm going to have to pay for weddings one day. So let's say that my kids get married when they are 25. So that's 19 years down the road for my oldest. Let's say I have to dish out $50,000 for the wedding. Maybe that's an inexpensive wedding for some. That's an expensive wedding for me. So your first loan, 19. Okay, I take out one loan. I pay it back over 10 years. And I charge myself, let's say, 10%. Typically, weddings these days are paid on a home equity line of credit or a credit card. And let's put some inflation on there. So at the end of my 30 years, I will have $510,000. The wedding has a, that's 32 plus 10, so a $42,000 impact. I will have that $50,000 back plus an additional $42,000. So these are average expenses that families have. As I stated before, the Buy Term Invest the Difference video shows you that you'd have to have a very high rate of return in a mutual fund without borrowing in a mutual fund to represent the accumulation of your properly set up life insurance policy without borrowing. By borrowing and using the infinite banking concept, you add a significant amount of value to your overall portfolio. Okay, you would have only had $358,000. Now with these 5 purchases, and obviously you have the capacity to make more purchases, okay, you add a significant amount of money. It's $510,000. So that might represent 13, 14, 15% is what a mutual fund would have to do to compensate for what your alternative would be, which is taking out a credit card, or taking out a car loan, or taking out a home equity line of credit. So the infinite banking concept is significant because it is very comprehensive as far as the role it plays in your overall financial plan. For more information about how you can learn more about the infinite banking concept, please contact us. All of our contact information is on our webpage. Our webpage again is www.paradigmlife.net. Thanks for listening.